Hello again. Before I start talking about specific entities like sole proprietorships and partnerships and corporations and trust, I like to talk about a wonderful deduction that non-corporate entities, that is sole proprietorships and partnerships and sub S. I'm not talking about a C corp. That is a corporate entity, but a sub S is a particular kind of a corporate entity that can take advantage of some wonderful, wonderful tax deduction. And first of all, let me bring it up on the screen. It's called the 20% qualified business income, or we call it the QBI deduction. Incidentally, anything that I put on the screen, anything, will be in the contents area of Brightspace. And I'll have it in, like this one will be in the session one, et cetera, okay? So this is quite extensive. That's why I want to go over everything on it. And it's a wonderful deduction. Let me give you a little background before I start reading. I'm going to read and make comments as I read on this, okay? The recent tax law gave a benefit to corporations. It reduced their tax from roughly 35% to 21%. But it did not pass this tax along to other businesses, including other businesses where there's a flow through to the individual's tax return. So there was an unfairness. So Congress created the QBI in order to help with that burden. So I'm going to start right from the top. Note, the reason for the deduction is to give a tax benefit to non-corporate entities who could not take advantage of the lower 21% federal corporation tax rate. Pass-through owners who qualify can deduct up to 20% of their net business income from their income taxes, reducing their effective income tax rate by 20%. This deduction began in the year 2018 because the law was passed in 2017 and is scheduled to last through 2025. That is, it will end January 1st, 2026 if Congress doesn't do anything about it. In other words, if Congress does not extend it. You must have a pass-through business to qualify for this deduction. So what is a pass-through business? A pass-through business is any business that is owned and operated through a pass-through business entity, which includes any business that is a sole proprietorship, and we'll be talking about that first in a little while, which is a one-owner business in which the owner personally owns all the business assets. It also could be a partnership, which is more than one owner. It could be an S corporation, which is a very small corporation. I will be talking about all these entities in a little while. Could be a limited liability company or a limited liability partnership. That's LLP. It also could be an LP, which is called a limited partnership. For tax purposes, what distinguishes these types of businesses is that they pay no tax themselves. In other words, the entity does not pay a tax. Instead, the profits or the losses from such businesses are passed through the business, and the ownership and the owners pay tax on the money on their individual income tax returns at their own individual income tax rates. So we call that a conduit or a flow through or a pass through. Again, the entity itself does not pay any income tax. It's the it's the owner of that entity or owners, like in a partnership, that would pay. The vast majority of smaller businesses are pass-through entities. Indeed, over 86% of businesses without employees are sole proprietorships. A regular C corporations do not qualify for this deduction. First of all, and I'm going to go into corporations later. What's a regular C? It's Chapter C in the IRS code. And these are corporations where there is double taxation. You tax, the corporation is taxed, so you tax at the corporate level. And then the individuals who receive dividends from the corporation are taxed. So it's called double taxation. Not exactly double. When we get into corporations, I'll go in depth into that. So again, regular C corporations do not qualify for this deduction. However, they do qualify for a low 21% corporate tax rate on all their income. Unlike the pass-through deduction, the 21% rate for C corporations is permanent under the TCIA. That's the recent tax law that went into effect at the end of 2017, and it's effective starting, the effective date was 2018, January 1st, 2018. Individuals who earn income through pass-through, now we're getting back to pass-through. Pass-through businesses may qualify to deduct from their income tax an amount equal to 20% of their qualified business income. Qualified business income from each pass, and I'll explain what that is in a little while. Qualified business income is the from each pass-through business they own. And this is IRS, Internal Revenue Code, section 199A. So again, qualified business income is net income, which was really profit, your pass-through business earns during the year. You determine this by subtracting all your regular business deductions from your total business income. QBI, which is qualified business income, includes rental income, so long as your rental activity qualifies as a business. And most of them do, quite frankly. It also includes income from publicly traded partnerships, real estate investment trusts, which are REITs, and qualified cooperatives. QBI does not include short-term or long-term capital gain or losses. For example, a landlord would not include capital gain earned from selling a rented property. That would not be included to get this 20% deduction. It doesn't include dividend income, of course. It doesn't include interest income. It doesn't include wages paid to S corporation shareholders. We're talking wages. It doesn't include guaranteed payments to partners in partnerships or LLC members. And finally, it doesn't include business income earned outside the United States. So it must be, the income must be earned in the US. QBI is determined separately for each separate business you own. You may have a number of businesses, so you have to work up. You quite frankly, this is what you do anyway. You know, you don't combine. First, you have to know what each of your entities is doing or did for the year. And then you make a combination for federal income tax purposes or for a presentation to a bank, or, you know, et cetera, et cetera. If you own multiple businesses that are not service businesses listed below, you have the option of combining them in one for the deduction, but only if at least two of the following requirements are satisfied. One, the businesses, because they're going to be multiple, provide products or services that are the same or customarily offered together. So there must be commonality. 2, the businesses share facilities or significant centralized business elements, such as personnel, accounting, legal, manufacturing, purchasing, human resources, or information technology resources, etc. And the businesses are operated in coordination with or reliance upon one or more of the businesses in the combined group. If one or more of your separate businesses loses money, you deduct the loss from the QBI of your profitable businesses. In other words, you net it out. If you have a qualified business loss, that is, your net QBI is 0 or less, like a negative, you get no pass-through deduction for the year. Any loss is carried forward to the next year and it's deducted against your QBI for that particular year. And then you keep on carrying it forward. If the following year is a loss, you're going to add that and carry that additional amount over to the next year. An example, this year, George earned 20, but all the examples that I try to give are small, okay? I'm not going to say the company earned, $80 million. I think it's easier. This year, George earned $20,000 in QBI from his Bitcoin mining business and had a $50,000 loss from his separate bakery business. So those are two separate entities and unrelated in business. He had a 30,000 qualified business loss. So he gets no pass-through deduction for the year. The 30,000 loss must be carried forward and deducted from his QBI in the following year or years. If he had income, So how the pass-through deduction is calculated depends on whether your taxable income, that's QBI income, plus other taxable income that you have on your personal income tax return, exceeds an annual threshold that is adjusted for inflation each year. Now, so far, I only have 2021. So for 2021, the threshold is taxable income up to $329,800 if married filing jointly, or $164,900 if single. If your income is within this threshold, your pass-through deduction is equal to 20% of your qualified business income. This is the maximum possible pass-through deduction. Again, as I said before, this is a wonderful deduction, a real wonderful deduction. And of course, then, it's not dollar for dollar. If it's let's say you take 20% of 100,000 for argument's sake, and that's 20,000. But if you're in the 50% bracket, then for Fed, state, and city, then you're only going to get the benefit of half of that. Okay. Another example: Tom is single and operates his public relation business as a sole proprietorship. His business earns $100,000 in qualified business income during 2021. He also earned $32,550 in investment income. And he took the $12,550. That's the current standard deduction. That's changing. Every year it generally changes due to inflation. His total taxable income for the year is $120,000. How do we get that? You take the $100,000 plus the $32,550 and subtract the standard of $12,550, and that's how you get the $120,000. His pass-through deduction is 20% times 100,000. That's 20,000. He may deduct 20,000 from his income taxes. Okay. If your taxable income exceeds the annual threshold, again, married filing jointly, 329,800, single, 164,900, etc. for 2021. Calculating the deduction is much more complicated and depends on your total income and the type of work you do. First of all, you need to determine whether your business falls within one of the following service provider categories. Are you in the health field? That's doctors, dentists, and other health fields. A law, like are you a lawyer, accountant, accounting, actuarial science, performing arts, consulting, athletes, financial services, broker services, investing and investment management, and trading and dealing in securities and commodities. There is a final catch-all. I don't want to complicate this, but there's a final catch-all category that includes any business where the principal asset is the reputation or skill of one or more of the owners or employees. Okay. IRS regulations narrowly define this catch-all category to include only cases where a person receives fees or other income for endorsing products or services, or the person licenses his or her image and receives fees for appearing at an event, etc. So that's not important for us. Architecture and engineering service are expressly not included in the list of personal services. You kind of don't want it to be a personal service. I'll explain in a moment. Pass-through owners who provide personal service are not favored under the pass-through deduction. Indeed, they lose the deduction entirely at certain income levels. There are no such limitations on pass-through owners who don't provide personal service. If your business is not included in the list of service providers, like you're not a lawyer or accountant and all of that, how you calculate your deduction depends on your taxable income. You know, whether it exceeds the threshold. If you're a non-service provider and your taxable income is 100,000 or more above the income threshold, if married filing jointly, or 50,000 if single, your pass-through deduction is fully subject to a W-2 wage business property limitation. Thus, if you're married filing jointly, the limitation applies if your taxable income is over 429,800, or if you're single, half of that, 214,900. Your maximum possible pass-through deductions is 20% of your QBI, just like at the lower income levels. However, when your income is this high, your deduction is further limited to the greater of 50% of your share of 50% of your share W-2 employees' wages paid by the business, and 25% of W-2 wages plus 2.5% of the acquisition cost of your depreciable business property. So you're going to have to work that up, that last one. Thus, if you have neither employees nor depreciable property, you get no deduction. This is intended to encourage pass-through owners to hire employees and or buy property for their business. This is if they don't meet, if they're higher than that particular threshold, okay? If they're lower than the threshold, generally speaking, there's no problem. The business property must be depreciable long-term property used in the production of income. For example, the real property or equipment used in business, but it can't be inventory. The cost is its unadjusted basis, the original acquisition cost minus the cost of land, if any. In other words, it's not going to be, you're not going to take cost, less land, less accumulated depreciation. I'm going to get into depreciation later on. It's going to be cost, less land. The 2.5% deduction can be taken during the entire depreciation period for the property. However, it can be no shorter than 10 years. And here's an example. Hal and Wanda are married and filed jointly. Their taxable income this year is $500,000, including $400,000 in QBI they earn from the bar business they own through an LLC. They employed 4 bartenders during the year to whom they paid $150,000 in wages. They own their bar building. So we're going to have that also. They bought it 4 years ago for $600,000, and the land is worth $100,000. So the unadjusted has to be $500,000. In other words, $600,000 less the $100,000. Their maximum possible pass-through deduction is 20% of $400,000, which equals $80,000. That's a fantastic deduction, incidentally, and it cannot be if you do it right, it cannot be questioned. The IRS cannot toss it. We call it tosses. You know, when the IRS deducts something. However, because their taxable income was over $429,800 threshold, their pass-through deduction is limited to the greater of 50% of the W-2 wages they paid their employees, or see if it's under, there's no worry, or 25% of the W-2 wages plus 2.5% of their bar building. It's $500,000 basis. So one is the 75,000. So that's 50% of 150. That's the wages. That equals 75. And then we're going to, and then the other one is take the 500,000 and multiply that by 2.5%. So when you combine 2.5%, item one is greater, so their pass-through deduction is 75,000. See, it's either or, but they can't take the 80 because they made too much. They're over the threshold. Okay. Many owners of pass-through businesses, especially landlords, have no employees. Thus, the 25% plus 2.5% deduction is of most benefit to them. In other words, the building, the net of the land, the building cost net of the land. Example: Alice is a single taxpayer. She owns a 5-unit building. I apologize. She earned $250,000 in total taxable income during the year. That's well over the $214,900 threshold for singles. She has no employees, so she's almost dead in the water in her rental business. Thus, her pass-through deduction is limited to 2.5% of the unadjusted basis of the long-term property she uses in her rental business. This consists of her building, which she purchased 5 years ago. Her unadjusted basis for the building, the purchase price less the land, is $500,000. Her pass-through is going to be 2.5% of that, or $12,500. So that's what she would get. Okay. Sadly, she's not going to get 20% of the 250, which would be 50,000. If your taxable income is less than 100,000 over the threshold, if you it's less than 100,000 over the threshold, if you're married filing jointly, or 50,000 if you're single, the W-2 wages property limitation is phased in. For 2021, and again, this is going to change. This applies to your taxable income of $329,801 to $429,801. $800. If married, filing jointly, or if you're single, the difference in between 164,901 to 214,900. In this event, only part of your deduction is subject to the W-2 property limit, and the rest is based on 20% of your QBI. The phase-in range is 100,000 for marrieds and 50,000 for singles. At the top range, your entire deduction is subject to the W-2 wages business property limit. If you have no W-2 wage or business property, you get no deduction. To calculate the phase-in, first determine what the amount of your deduction would be if the W-2 wages property limit didn't apply at all. This is 20% of your QBI. Next, calculate your deduction as if the W-2 wages property limit applied in full, even if it doesn't. Your phase-in amount is based on the difference between these two calculations multiplied by your phase-in percentage. You know, the higher you go, the more that's going to be affected between. You know, if it's between 100 and 200,000, for example, if it's so we're talking let's say 150,000, then that would be higher than it would be at 125,000. And here's an example to back that up, what I just said. Excuse me, Sid and Nancy are married and operate an equipment rental business as an LLC. Their QBI this year is $359,800, and the business pays $100,000 in W-2 wages and owns no property. Their phase-in percentage is 30% because $359,800 QBI is $30,000 over the $329,800, right? So you take that $30,000 and you divide it by the phase-in of $100,000, and that gives you 30%. Their deduction, if the W-2 wage property limit didn't apply, would be 20% of $359,800, which equals $71,960. Therefore, their fully limited deduction based on W-2 wages is $50,000. That's 50% of the 100 in W-2 wages. They should lose 30% of the difference between the full deduction of $71,960 and the full limited deduction of $50,000. The difference amounts to $6,588. How did we get that? Take 30% of $71,960 less the $50,000, and that'll give you $6,588. Thus, they should lose $6,588 from the full $71,960 deduction. Therefore, Sid and Nancy can take $65,372 pass-through on their tax return. Had their QBI been $429,800, their phase-in percentage would have been 100%, and the deduction and the total deduction limited to 50% of their W-2 wages, or $50,000. I understand that many of you will not use all of these, but it's good to know. And you're going to have it, you can copy it out and keep it. If your business involves providing personal service and your taxable income is over $329,800 or the $164,900, you know, for married versus single, your pass-through deduction is gradually phased out up to $429,800 for married and $214,900 for single of QBI. At the top of the income range, you get no deduction at all. That is, if your total income is more than $429,800, if you're married, or $214,900 if you're single, you get no deduction. This was intended to prevent highly compensated employees who provide personal service, like lawyers, for example, from having their employees reclassify them as independent contractors so they could benefit from the pass-through deduction. Congress was really thinking about this. They really were. They put a lot of effort into this. There is no such phase out of the entire deduction for non-service providers. That's my opinion, incidentally. To calculate your deduction, you start by using the same formula as for non-service providers discussed above. Your maximum possible deduction is 20% of your QBI, right? That doesn't change. However, your deduction may not exceed the greater of 50% of your share W-2 employee wages paid by the business, or 25% W-2 wages plus 2.5% of acquisition costs of depreciable property, just like we talked about before, used in the business. Thus, if you have no employees or depreciable business property, you get no deduction at all. Next, you calculate the phase out of the deduction. If you have employees or property, your deduction is phased out by 1% for every $1,000 income exceeding the 329.8. When your income hits the 429.8, you get no deduction. 1,000 times, that'll be 100,000. If you're single, etc., your deduction is reduced by 2% for each 1,000 your income exceeds 164.9. So therefore, you get no deduction when it reaches 214,901. An example of this: Mark is married and files jointly. He earns $359,800 in taxable income this year. His sole proprietorship consulting business earned $359,800 and paid $100,000 to its employees. Consulting is one of the specific businesses. You remember I said that before. So his pass-through deduction is subject to the phase out. His $359,008 taxable income is $30,000 or 30% over the 329.8 threshold. Before the phase out, his deduction is limited to 50% of the W-2 wages he paid, which was $50,000. Because his phase out percentage is 30%, he gets 70% of the full deduction, or $35,000. Finally, the pass-through deduction is a personal deduction. You may take on your Form 1040, whether or not you itemize, it doesn't matter. It's a great deduction. It is not what we call an above-the-line deduction on the first page of the Form 1040 that reduces your adjusted gross income. That's what we call that AGI. Moreover, the deduction only reduces income taxes, not Social Security or Medicare taxes. Okay, it's only for income taxes itself. Okay, and that ends this session. Next session, I'm going to get into specifics on. I guess we'll start off with a sole proprietorship. Okay, so the next session, I'm going to go in depth to a sole proprietorship.